Good morning, everybody, and welcome to this live economic update. My name is Martin Gagnon. I'm Executive Vice President, Wealth Management at National Bank of Canada, and today I am with our Chief Economist, Martin Lefebvre.
Hello, Martin.
Good morning. So, as many of you are aware, we used to do economic dinners and lunches across the country. We're trying a new way of reaching out to all of you, to all of our clients, and to still try to add value with some economic insights. So let's do this right away, and let's start without further delay. So, Martin, there seems to be a disconnect going on between the economy and financial markets. So let's get into this and maybe start with a bit of an update on where we stand with the pandemic.
Okay, very good question indeed, Martin. But by what we are seeing in the markets, there seems to be effectively a disconnect in between these two realities. So why don't we start with the economy? So the root cause of everything that we're living right now, obviously the COVID-19 pandemic, the uncertainty, everything is linked to this illness. And what we know so far is that there's been more than 400,000 people that have died from the disease. There's still more than 7 million active cases out there, and of those, about 25% are in the U.S. alone, for an amount of nearly 100,000 deaths already in the U.S. So, Martin, we're going to be spending a lot of time on the U.S. economy because it's important for investors to understand that it's 1/4 of the global economy, but it's 50% of the market capitalization. So it's really important to understand what's going on in the USA. So, on the one hand, you got all these dead people from this illness, and that has taken its toll on the economy, that has grinded to a halt, basically. So far what we know is that there's been nearly 20 million jobs in the U.S. alone since February. And if you can observe on chart 3, what we're showing is that on the bottom part, the red line, that's more than twice as much of all the jobs that were lost during the great financial crisis, and probably the highest number ever recorded as far as we can go back in terms of data. And to us, it means that in a matter of just 2 months, we've erased all the jobs that were created in the recovery following the great financial crisis. So in a matter of 2 months, we've erased what was created over nearly 10 years. So that's really enormous, and that's taken the unemployment rate to an 11-year high, as you can see here on the chart. So we went from one of the best labor market in the U.S., the lowest unemployment rate at 3.5%, just saying that the U.S. economy was in a really good spot in terms of economic activity, to one of the worst economy in the past 80 years, bringing us back to during the Great Depression era. So this had a few devastating consequences, Martin, as you can see here on chart 5, basically, and more particularly on the tourism industries because of the nature of this crisis. So whether it's hotel chains, restaurants, recreation, transportation, and retail trade, employment in these sectors have really felt the brunt of this crisis so far. And luckily for us, it only represents 9% of GDP. But if you take this 9% that was basically almost halted at 100%, and you had the industries that were also working, at a weaker capacity than usual, that means that basically the economy is seen shrinking at some sort of a depression-like pace in the next few months. So what we know so far, the red line, which is here on the chart, the U.S. real GDP year-over-year growth, has grinded to a halt because the lockdowns happened mostly in the second half of the month of March, so at the very end of the quarter, but we know that the worst is yet to come because the lockdowns were more actively seen during April and May. So therefore, we know for a fact that the economy is going to be very weak during the second quarter, and that's yet to be seen. We'll only know the true numbers sometimes in July once June is over. So basically, just to summarize, a great health crisis. A lot of people have lost their job, and we know for a fact that the economy has grinded to a halt during this period. And meanwhile, what we're seeing is that equity markets have recovered at an unprecedented pace, Martin, as you can see on chart 7.
So a pretty drastic economic impact, yet equities are flirting with new highs. What's going on?
Yeah, okay. Before we get to that, I just want to say that there is a link in between equities and the economy, and that's via the earnings expectation, of course. And at the beginning of this crisis, what we saw is that equities went down nearly 35%, entering the bear market territory, as we can see on the chart. So we can see on the chart, by comparing the current bear market that we're in with the other types of bear market, those usually linked to more cyclical or structural nature, because interest rates are going up or because there's an overeating of the economy. And that's not really what we're facing right now. It's really a healthcare issue, and that's why the economy went down. So the stock markets went down so fast. I mean, 35% correction in a matter of a few months. That's unprecedented, as we can see. The only close event that is that we can observe that's similar to this impact was in 1987, but you can see that the recovery almost took 2 years before we went back to normal. So again, the recovery was very quick, but I think that there's a few elements that we need to highlight to for people to understand why we're at this point right now. So the first one is that there was tremendous stimulus on the part of governments everywhere around the world. So there was a really concerted efforts from every major countries around the world. And as you can see on chart 8, it's really like wartime deficits. It's never happened in the history of the U.S. economy that we've seen such deficits in normal times. So it's amounting to some in between, somewhere to 10 to 12% of GDP. So that's really enormous on the part of the government authorities on the one part. Also, on the in terms of central bank easing, it was also very fast. I mean, they've acted very fast, very forcefully, and they brought interest rates down to 0% in a matter of just a few weeks. And they've also started, all sorts of facilities that would help households and also enterprises, firms get access to credit. So they've created all these credit facilities that will help them out to make sure that they would keep their cash flows in these very difficult time. And then finally, also the healthcare authorities came out with a solution to confine people in their homes to make sure that we would get through this problem as quickly as possible, to make sure that we would not enter sort of a depression-like era, which would have taken, like years to come out of. So I think that all of these stimulus that were put forth, Martin, really helped the stock market regain confidence in this environment.
But again, valuations are really high. That's a comment we're getting all the time.
Yep.
We got to get deeper into this.
Probably, but there's already winners and there've been winners and losers as in every bear market or even recovery.
Yep.
And take airlines and cruise ships and accommodation, hotel chains, for example. You take those, even though they managed to rebound since the trough of March 23rd, they remain at very depressed levels. Okay, even cyclical stocks are very depressed as we speak. But we were asked to work remotely, and that's why, and stay home, confine ourselves at home, and that's why technology-led industries have really benefited from this type of environment. Think about computers, think about media, think about offline shopping. All of those really have benefited from this crisis. And you can see that in terms of S&P 500 sector allocation, those are really the heavyweights of the S&P 500, and it really helped the index as an aggregate move upward during this recovery period. So that's the first thing. The second thing is that even the defensive sectors have acted pretty well. Think about healthcare. And healthcare, obviously, for the good reasons. I mean, it's a healthcare crisis. Have done pretty well. There's a lot of effort in finding a vaccine or a medication that will help tame the effects of the illness going forwards. And all of those sectors have also benefited. And then there's also the fact that we talked about employment, Martin. But if we look at the case of the Canadian economy here, we're seeing that it's people in the retail industries are not the most paid people out there. They're not the most paid employees, and you can see that there's a discrepancy in between those that have the least paid jobs versus those that are well paid in the industry, and therefore those that were kind of richer continue to have a job, and they're able to save and they're able to invest, and that's pretty much what we saw over the past couple of months, and it's helped out in this recovery in great details.
Yeah, that's a good point, though. It could unfortunately increase disparities.
Well, yeah, but that's something that our governments will have to
Exactly.
be facing in the near future. And then there was an element, I think, Martin, of hope, right? At first, people were shocked by this crisis, and the most catastrophic scenarios were put forth, and then, slowly but surely, we were talking about reopenings, and this is a great example here on chart 13, a mobility index put together by Google, looking at the mobility or the activity in shops, groceries, work, and public transit, and we can see pretty much that at some point at the beginning of April, activity started recovering at a good pace. Okay, so that's the element of hope that's really important in this recovery. And another element of hope is the fact that most of the people that were laid off was on a temporary basis. So that means that as soon as we reopen the economies for good, most of these people will be ready to go back to work, and that's also a very good thing. And we already saw a sort of a glimpse of that with a big employment surprise during the month of May. People were expecting that during that month that there would still be a few people that would be laid off, and it was the complete opposite. In fact, 2.5 million new jobs were created. So it means that indeed economies are reopening and people are going back to work. And the unemployment rate ticked down from nearly 15% to 13.3%. So that's really important to understand, because usually the end of a recession starts with the unemployment rate improving. So it could have been. It means that at some point it could be one of the worst recessions, but also the shortest in terms of a total length. So that's really something that would be encouraging going forward. And we're really we're seeing sort of a pickup in activity. We're already seeing that in China to start with, manufacturing wise, and we're seeing a reversal also in the Eurozone and in the U.S. and also everywhere else in North America. So that's something really important to understand, and it means that even though we know for a fact that the second quarter is going to be very dire in terms of economic activity, that there's going to be a rebound at some point, and that's where I think the focus should be for investors. So Wednesday, the Federal Reserve gave us a few projections that are really interesting, and you can see here on chart 17, and I'll share that with you. First, for the whole of 2020, because we're expecting that the second quarter is going to be really bad, but then in the second half of 2020, there should be a rebound. As a whole, it's going to be minus 6.5% in terms of the magnitude of the contraction in the United States, and that's going to be something similar here in the country. But you can see that in the years to come, it should be a pretty hefty rebound. So 5% for 2021 and 3.5% in 2022. So because, from a very low standpoint, we're going to be growing at a fast pace following that. And the markets are kind of grabbing a little bit of that going forward. It's going to help unemployment rate go down from 9.3% to gradually something more sustainable in the long run and more in line with what we were accustomed with over the past couple of years. And something really interesting that the Fed said, the forward guidance was really strong last Wednesday, and they told us, Martin, that the Fed funds rate would remain basically at 0% until the end of 2022, and that's really something really important, and that's going to offer a lot of support going forward for most of the markets. Then there was another element of hope during the past couple of weeks that helped the stock market go up, is the fact that there's also a huge effort in terms of a race for a vaccine. So everybody's working together. Every country is putting the effort to make sure that a new vaccine will be created. And never in the history of humankind has a vaccine been created for a coronavirus strain, because they're always mutating and all of that. But right now, because of all of the efforts that have been put forth, usually a vaccine takes, and I'm no expert, obviously, but usually what I read is that a vaccine takes between 12 to 18 months to be in production. And right now, we're already at some for those some of these works in at phase 2 and phase 3. So that's really promising, and we're expecting a vaccine that could be in line for September, and that would really help out in terms of if there's a second phase at some point in time, Martin.
Good. So hopefully the worst is behind us, but we still have to embed some risks in our forecast. So what could they be?
Yeah, that's a good question. Well, obviously there's there's an upcoming U.S. elections. It's at our door. It's November 2020, but it's only a few months away, so that could create some tensions, specifically in between China and the U.S. That they've signed an agreement last year, but trade could always be an issue in all of this, and because the USA kind of feels that all of this is the China's fault, there should be renewed tension. So we'll have to monitor that very closely. I think that the most important risk, though, going forward will be that, well, first of all, the first wave is not even over. There's still some hot spots in the USA, and there's also like India and Brazil, other emerging countries that are really important to monitor at this point. And then there's the risk of a second wave, Martin. If you look at the example here on the chart 19 of the Spanish flu, soon after they removed all of the containment orders, there was a second wave. So we'll have to monitor that very closely. Although we feel that today's pandemic is quite different from the one that happened in 1918 with the Spanish flu. At that time, almost 87% was aimed at young adults and children, and nowadays it's more elderly people that are the most affected. So that's a big difference, and I think that if we had known that children would kind of be immune to this COVID-19 disease, probably we wouldn't have closed schools. And we feel that if there's a reopening, if there's a second wave, that will probably not act the same way as we acted in the first part of this disease. So that's the first thing to know.
Good. Let's talk about the implication of all of this on major asset classes, and tell us a little bit about your forecast.
Okay, so the first thing we know is that interest rates will remain very low. As I mentioned, the Fed, through forward guidance, has told us that interest rate would remain very low for a very long time. So for yield chasers, it means that there's not going to be much of an opportunity in bonds. But that's going to pave the way probably for an alternative that's really holding a lot more potential, which continues to be equities in our minds. Because interest rates are low, it means that the discount rates are also lower, and it means that what we call the equity risk premium remains quite elevated on a historical norm, and that means that probably equities, once all of this uncertainty is behind us, because we're at the beginning of a new cycle, there's a lot of monetary easing, a lot of fiscal easing, and we're able, once we're kind of we're reassured that the worst is behind us. We think that the equity market will embark on a more gradual and more sustainable pace in terms of returns for the next few years. And the focus in terms of earnings should shift from 2020, which was really dire everywhere across the world, to probably 2021. And that's going to help out in terms also of valuations. Like Martin mentioned, stock equity prices are high right now, but earnings are really depressed. So in terms of valuation, it means that the ratio of the multiples are really high. But once we focused more on 2021, probably that these ratios will improve, and it means that there's going to be more upside potential going forward. So that's the one thing. And that's pretty much, Martin, what the history is telling us. So we've looked at all of the 10 best quarters since 1973, and well, so far we're up somewhere around 15%, 18%, a little bit less because of yesterday's correction, but nevertheless, it's been a very rapid pace so far over the past 3 months. And usually, what it's telling us is that good quarters are good omen for next quarters, and even the following year, the following 3 years. So we're really encouraged by the statistics of such numbers, and it's boding really well in terms of economic, then also the impact on the stock market going forward.
Good. We can't conclude this without talking about the price of oil, obviously, with a lot of people listening to us from out west, and also the Canadian dollar.
Yeah, okay, we'll finish with that. So we think that oil prices will probably stabilize around current levels, obviously for different reasons. The number one is that there seems to be an adjustment in between supply and demand. So what I'm showing here on page 27 is that obviously consumption has collapsed. There was really like demand collapsed because of the nature of this crisis. Transportation were hit very badly. People are staying at home, so they're not traveling anymore. Air transportation, all of those were, have grinded to a halt in terms of economic activity. And as such, production had to go down to make sure that the price could stabilize. But we can see that even though consumption is expected to continue to go up, that there's still, a difficulty, and more adjustments will be needed in terms of production, because there's a capacity issue. It'd be great if we could just continue to produce at the same level and just build inventories, but it's not feasible. We have to put it somewhere. And when we're looking at inventories in the USA, for example, we're already flirting with maximum capacity. We're way higher than what the norm is of the past couple of years, and that's having an issue. And as such, we'll have to see more cut of production before we can feel that oil prices will go up on a more sustainable level. So the economy has got this, kickstart, start anew, and then production also has to do a little bit of its part for oil prices to stabilize. And because we're expecting oil prices to stabilize around current level, usually it's a pretty good indication where the U.S. dollar will stand in the near future. So I'm showing this on chart 29. You can see that there's a tight correlation in between the oil prices, the red line here on the chart, and the Canadian dollar. It's almost 1-for-1. And because of that, we think if oil prices, stabilize around close to $40, that's pretty much where the loonie should be as well in the near future.
Excellent. Well, Martin, thank you for listening. We're trying this new platform. Hope you enjoyed it, and we will be back later. Thank you.
Thank you, everyone.